etc. C. Yogesh Kumar Kapra is a senior member having an extensive experience of more than 30 years in company law, corporate structuring, management advisory, audit, and assurance services. An avid speaker and an expert in law and bankruptcy code. He has addressed more than 180 seminars, forums, and conferences on company law, LLP, insolvency and bankruptcy code, and standards on auditing. A strategist and leader to the core. He has conceptualized, implemented many initiatives as WIRC during his chairmanship. As an active and responsible member of trade industry, he is associated with various social forms as well. Now, over to you, sir.
Thank you. I'm audible?
Yes,
Yes.
sir.
Okay. Thank you, Gaurang. Thank you, Amit, for introducing me and inviting me to share some of my thoughts before Yogesh Amal, the speaker for the day, takes over the charge. But Gaurang, you missed out. There is not only one central council member, the another central
Yes,
council
sir.
member is
Sorry.
Rajkumar Adukia ji. He is a very senior central council member, as well as Rajkumar Adukia ji is also past chairman of the WIRC. So he is a guiding force for all of us. And he has lot many credit to him as far as the sharing of knowledge is concerned. Through the books, through the mailers, and even through the various webinars or so. So thank you very much, Gaurang, and thanks, Rajkumarji, Bhaiji, you are there. Thanks for being present over here. Friends, as you all know, that the schedule 3 has been amended wide notification dated March 24, 21st, and there were certain amendments with respect to Schedule 3, Companies Accounts Rule and Companies Audit and Auditors Rule. The important for all of us is how Schedule 3 is impacting for the preparer and how Schedule 3 and CARO is impacting the person or the chartered accountants who are conducting the audit. And these amendments, which has taken place from March 24, 2021, has been made effective from 1st April 2021. So March 22 balance sheet, you need to prepare, or one need to prepare on the basis of the new Schedule 3, as well as the chartered accountants who are the auditor and the firms who are the auditor, they need to report in CARO 2020. So this is what is needed today, and it is very important since some of the listed company have already come out with the result, and some of the listed company will end their year and will publish their results by maximum of 30th of May and 15th of May, and all other private limited companies will be publishing or will be making their accounts or will be preparing their financial statements before 31st of August, because we normally file the returns in the month of September, but you need to give 24 days clear notice for the AGM. So officially it is in the last week of August, or maximum to the extent of first week of September. So friends, the Schedule 3 amendments are made to bring more transparency, enhance disclosure, and comparative informations. That is what is needed as of today. The enhanced disclosure for companies to which Indian GAAP and Ind AS is applicable, and also for the NBFC. Assess and make changes to existing systems, controls, and processes. It has enhanced the auditor's reporting requirement in addition to CARO 2020 also. And the CARO 2020 report has been aligned, or I would say that the Schedule 3 has been aligned with CARO 2020 reporting, because CARO 2020 came first, and the Auditors Institute has also represented, and these kind of amendments has taken place in Schedule 3. So the burden comes on the preparers and they adhere to all these things. So we need to gear up for all these kind of changes which has taken place. The important changes which I believe which have changed in CARO is with respect to the CSR expenditure. When in case of the share capital also, a company promote what new disclosure requirement as compared to earlier is disclosure of shareholding of promoters and percentage of change during the year has been added for all companies, which was not there earlier. Then there is changes with respect to trade payables, trade receivables, and where the requirement is of the aging schedule is to be considered. Also, you need to find out the end users of the fund. That is most important. Where you have to find out the trail, that where the ultimately money has gone. Money has been taken on loan and it has been used by somebody for some other purposes, then it is not allowed. So it is a responsibility of the management as well as of the auditors to find it out and report if it is not there. So I believe that these kind of amendments which have come over here with respect to trade payables, trade receivables, and use of funds, these are going to help the stakeholders who really want to invest. Bankers will come to know what are the things who have funded the companies, whether the company is performing well or not. Then there are the changes in tangible and intangible assets also, capital work in progress. Also, you have to give aging schedule for capital work in progress and tangible assets under development. So this also will show. Normally, the people were showing capital work in progress and there was no account. So whether it can be continued now. So that will that is required to be reported and that is required to be disclosed. And it will give the transparency. The funder, the lender, the stakeholder will come to know what is the exact status of the project, what is the exact use of the fund, and then accordingly, if somebody wants to invest into that company, would take the decision with respect to this. So I believe that these kind of things which have taken place, it is good for us. No doubt, this has increased the responsibility on the auditors to report more. But let me tell you, bringing these kind of transparency and bringing in the audit work through the audit quality is only going to make the difference and will boost the image of be professional. So let us try to adhere to the best practices which are available in the industry or in the professions for us to prepare and disclose the facts in the right way and to report the same judiciously. If we do not do that, then the fingers are being raised on us. And when the fingers are being raised on one chartered accountant, one auditor, one CFO, then friends, these fingers are on the whole profession and the whole profession is impacted by it. So my humble request to all of you, while preparing this balance sheet, new schedule, on the basis of new schedule 3, be careful, disclose the facts, and also a humble request to all my colleagues who are the auditors, see that proper reporting is done, compliance with the standards on auditing is done properly. So the whatever you want to convey the message to stakeholders, you can convey. We need to understand this very carefully. The auditors are the watchdog, as of which is defined today. But friends, the regulators are expecting in a different way that we should be bloodhound. Let me tell you, there is one more dog, that is sniffer dog. And ultimately, what is the habit of the dog? If there is any suspicion, dog starts barking. So let us not stop ourselves from barking. Please bring it out to the knowledge of the stakeholders, and that will make difference. So friends, my humble request to all of you, please adhere to all those things which are required, and see that the flag of the profession flies high. These 32 elected members whom you have sent, they can help you out, but ultimate responsibility is of all of us. If we do the things judiciously, we are, because of the Companies Act, we have to follow whatever is there in the Companies Act, that, and accordingly we have to work. Our existence is because of Companies Act. So standards on auditing, accounting standard, reporting is more important than your tax consultancy work or so. So you have to be very careful while drafting the report, while conducting the audit of the companies, while preparing the financial statement, that you prepare it in a right way. With this, friends, if I wish to talk, I can take the whole session on my own. But since today there is a speaker, Yogesh Amal, he'll be taking, and I came to know before, when I joined and when this was not started, that he is from a firm which is 65-year-old firm. So he is having the legacy of the experience of 65-year people in that firm. And I'm sure when a firm is there for 65 years, then the quality of work is being carried out over there. So he will share with all of you that how this Schedule 3 is impacting all of us, and what kind of things are to be kept in when you are preparing the financial statement, and what kind of questions are to be kept by the auditors when you are auditing these financial statement which are being prepared on the basis of the new Schedule 3. With this, thank you, Gaurang, for giving me an opportunity to be here to give the keynote address. And let me assure you, if anything you need from my side, Rajkumarji's side, from the council side, any help this study circle needs, any good speakers you need, any program you need, please let us know. And how you people can contribute to the well-being of the institute, please let us know. Thank you very much, Gaurang. Thank you, Amit, and thanks everybody. And a special thanks to Rajkumar.
Thank you so much, sir. So it was our pleasure that you accepted our invitation as a keynote speaker. And thank you for your humble words and your continuous guidance to the study circle and to the all the members of our profession, sir. Now, before allowing our speaker to start his session, I would request Amit to please give introduction of our speaker.
Yeah, it's a great pleasure for me to introduce our speaker, CA Yogesh Amal. He is a commerce graduate from Mumbai University and a fellow member of the Institute of Chartered Accountants of India. He qualified in the year 2001 and is in the practice since then. Presently, CA Yogesh Amal is a partner at GBCA and Associate LLP, Chartered Accountants, Mumbai. CA Yogesh has been instrumental in GBCA forays into business support service and outsourced CFO practice, and is experienced in managing audit of large corporates, including listed companies, multinational companies, and PSUs under various ERP environments. His area of expertise expands to providing accounting advisory service and his experience in Indian GAAP, Indian AS and IFRS. He has delivered talks at various seminars for professional on tax audit, standards of auditing, Schedule 3, etc. Currently, he is member of Accounting and Auditing Committee at Chamber of Tax Consultants. In addition to the contribution in various journals, he has also co-authored the following publications: BCA's publication, reporting under the new format in Form 360, WIRC publication, analogy on Ind AS notes and disclosures, CTC jointly with Taxman's publications, comprehensive guide on Caro 2020. With this, let's give a warm welcome to Yogesh. Sir, over to
Yogesh,
you.
sir, you can start your deliberation.
Yeah. So thank you, Amit, for nice introduction. Thank you, Andheri AWSC Study Circle, Gaurang, Amit, for keeping faith in me and allowing me to share my views on Schedule 3 requirements. Thank you, Rajkumar ji. Thank you, Durgesh ji. Thank you for acknowledging our firm and acknowledging me as a part of our firm for last so many years. So with this background, let us start to the session per se. Now, before I really start the discussion on the subject, let me rather put some disclaimers before we start. So yes, though I have an experience of last so many years working in this area, but yes, I keep on learning every day. So I don't call myself an expert. I learn along with all the members, and subject being new this year, definitely I have to, one has to keep his mind open that yes, there could be a new areas or new things which one has to keep on learning every day. So yes, I'm not an expert on this this subject. I keep on learning every day. But yes, I would definitely share the views which I felt which would be necessary or important while keeping these discussions in mind. Another important aspect one has to know that we may not have answers to all the questions, because this being a new, one will each topic or each question would be very facts driven, and we may not have the apparent answer or immediate answer right now. But I will try to address as much as questions possible with my experience or based on the subject content available in general public domain. Right now or today, what we are really going to discuss is broadly the amendments on Schedule 3 and not Caro. But let me assure you, all of you, once you've gone through the Schedule 3, Caro is indirectly going to get covered. As Durgesh ji rightly said, that Caro was implemented first and then this Schedule 3 to amendments came later. So effectively what is done is whatever requirements were there in Caro have now been incorporated in the Schedule 3. I am really happy this happened, because earlier what used to happen is any reporting requirements which were there in Caro, management used to not support on those compilations because they were putting the responsibility that yes, this is auditor's report, you have to take care of, we are not supposed to report anywhere, we are not supposed to report anything, and hence it is your job. So in a way, this is really a welcome amendment that now there is an equal responsibility of the management and auditors, which is by way of Caro. So most of your Caro requirements or reporting requirements would get covered in the amendments to Schedule 3. So this is, and hence we are not discussing Caro, we are only discussing amendments and not the complete Schedule 3, because with the given time, you cannot discuss all aspects of Schedule 3. But at the same time, we are also assuming that the members have already been working on Schedule 3 and they know what are the basic requirements. Broadly, the coverage of the presentation will be like this, that I would just brief about the Schedule 3, then the amendments which are general in nature, amendments which are affecting asset side, liability side, and profit and loss. So this would be the broad flow of the presentation. Again, currently the presentation is prepared keeping in mind Division 1 of Schedule 3. Division 1 basically is applicable to the entities which are following accounting standards. Whereas, let me assure you, barring few couple of cases or few couple of presentations, the amendments are absolutely same as far as division 1, 2, or 3 is concerned. Wherever there are changes, I will highlight that yes, there is some amendment here in schedule 2 or 3, but broadly keeping the participants or members' interest in mind, what I have done is we have kept my schedule, my presentation restricted to schedule division 1. And again, before actually starting the presentation, let me tell you, friends, this compilation is really going to be a huge task. You will have to start right away, involve management or the preparers of the financial statement in this process, so that uh, you have a smooth journey until you are finalizing the financial statement. So with this brief background, I would start with my presentation. Gaurang, let me know, how do we take the questions? Do you want to take the questions in between, or you want to keep it for last?
So,
My suggestion would be to keep it as and when they come up, because it will then, so one will be able to correlate with the subject where we are discussing, or the topic which we are discussing. So this would my suggestion be, but I am open to anything.
as per your comfort.
Okay.
If,
So we'll
if you
try
are
to
okay.
cover the questions as
So
and
you
when
need
they
to.
have come.
So you need to share your screen also.
Yeah,
No?
I've still not done that. I am aware.
Okay. Okay. Okay.
So with this background, let me start and share my screen. Just allow me for a second. Parang, let me know if the screen is visible. Okay. So to begin with, as I said, let me just brief the general about Schedule 3. It is coming by way of Companies Act. And as we discussed that it has got 3 divisions, division 1, 2, 3. Division 1 broadly talks about companies which are following accounting standards. Division 2 talks about companies which are following Ind AS, and Division 3 talks about entities who are NBFCs. So that's how it is. My humble request to participants, if you can mute yourself so that we don't get distracted with the background. So Division 3 is the format which is for NBFC. A few important questions one has to understand: that what happens in case of conflicts between the Act, standards, and Schedule 3. So here it is clearly clarified that Act and standard will prevail over the schedule, meaning if there are an additional requirement required by the standards or the Act, those disclosures have to be made in accordance with those Act and standards. Then the question can arise is whether the disclosures mentioned in Schedule 3 are minimum, maximum. How does that work? So the answer is these are the minimum line items which one has to disclose. For any better disclosure or for better governance, if you have additional disclosures to be made, definitely you can add additional line subline items. You can also substitute to few important line items as with a background that if you feel that those modifications will give the stakeholders a better picture of the subject or the financials, then you can do that also. Okay, quickly, briefly, why the change in Schedule 3 was necessary. So the background behind this, or the rationale behind these amendments, were yes, the authorities wanted the transparency on all the disclosures. So when you see these disclosures, simply looking at these disclosures, one will raise so many questions. Of course, as and when we come on those relevant subjects, we will see that what kind of questions can come up. So they wanted transparency on the financial statements. There were a lot of NPAs happening in banks and NBFCs. So the disclosures were required. A lot of public money was utilized somewhere else. A lot of money laundering was happening, which was not getting captured in the existing format of financial statements. Hence, there was a need to ensure that those details or disclosures are available within the financial statement, so that reader or the stakeholders can take the confirmed or the conscious view before investing in those entities. The objective was to report the early warn or give the early warnings or red alerts in case of any corporate failures which were supposed to be happening, and to align the financial statements in accordance with auditor's report, which we discussed that Caro is almost brought in line with Schedule 3. So the next question comes is, when was this applicable? It is applicable from 1st April 2021. Friends, let me tell you, this is equally applicable to comparative statements. So all the information which we are disclosing or discussing, though this is applicable from 1st April 2021 financial statement starting from this date, all the information which are required for comparative period also has to be compiled and reported. Whether this is applicable for interim financial statements, yes, this is equally applicable for interim financial statements. So the one question which can arise here from this applicability date is, assuming if the date or the financial statements were starting from 1st January 2021 and the calendar year is used as a financial year, then what happens? So the answer is, it would not be applicable to the entities who are following or whose financial statement started before 1st April 2021. However, as a practitioner or as a chartered accountant, my view would be fine. This may technically not be applicable to 1st January 2021 starting financial statement, but one has to be, as a good corporate governance, one can still prepare and make this or make these disclosures even for the financial statements which are ending December 2021. So this was the broad brief background about Schedule 3. Now coming to the specific amendments which are made. Okay, so in addition to, as I mentioned, that division 1, 2, 3, these amendments are equally applicable to CFS. So what I have done is the amendments which are applicable to SFS or CFS, I have mentioned as if these are applicable to both CFS and SFS. Wherever it is only applicable to SFS, I have reported as these are only applicable to CFS. So that kind of bifurcation or segregation has been done in the course of presentation. So starting with first change which has been made is mandatory rounding off requirement. Now, earlier, the companies had choice that if they wanted to report in full numbers, they could still do so. With this amendment, it is not an option. Now it is mandatory for the entities that they have to round off their numbers, meaning that now you cannot have the financial statements in actual numbers, you have to round off. Now, what are the criterias of rounding off? If the total income is less than 100 crores, then you have to round off in nearest 100,000 lakhs millions or decimal thereof. And if the total income is more than 100 crores, then the rounding has to be lakhs, millions or crores. There is one more technical change made in the requirement, which now talks about total income. Earlier requirement of this rounding off was total turnover. So what does this difference mean is total turnover. When we were used to see before, we used to see only the revenue from operations line item, whereas now it is total income, which means that total revenue, revenue from operations plus other income makes it to total income of the entities. So this is the parameter which one has to now see for mandatory rounding off. Cosmetic change on the face of P&L has been done, wherein earlier there was they used to call this line item as a different line item. Now they have replaced that as a total income to align with this mandatory requirement. So this was one general change which is universally applicable to all the entities. One cosmetic change done is Sbn reporting. Of course, for all practical purpose, all of us were not reporting, but now formally they have removed those reporting and it is not part of the Schedule 3. But until last year, it was still a part of Schedule 3 reporting requirement, but the industry had taken view, though it is there, but this requirement was only for the specific period, and hence we had stopped reporting on that. Any questions so far?
Members are welcome to, if they have any questions, they can unmute themselves or, enter any queries in the chat box right away, and speaker will be, happy to address the queries as and when it comes.
Sir, this is Arun Sureka.
Yes, sir.
Can we round it up to nearest 100,000 or like that is our option for less than 100 crores income?
Yes. So you have to make a choice.
And that is our choice.
Yes. So they are
Okay.
giving option of, if your income is less than 100 crores, then you can do it at nearest 100,000 lakhs or millions or decimal thereof is your choice. So you can select out of any of these options.
Okay. Thank you. And
But
that
the
we have to
moment,
continue
but the
for
moment you are more than 100 crores, you cannot follow hundreds or thousands. You have to select within this lakhs, millions, or crores only.
Okay, sir. Thank you.
So let's move on to the next very important requirement. This is really going to be a humongous task. I'm not sure how will company manage this data. Auditors will keep the documentation for all this data. So let me also share with all the members that though company would disclose this information based on their analysis or compilations, but as an auditor, we will have to ensure that sufficient documentation is maintained for all this review, so that whenever at later date any peer review or NFRA or any authorities which questions on our work, our document should be in a position to speak ourselves, and we should not be in a situation where we are not able to explain on what basis have we taken any specific view on disclosures or reporting. So as in members or as in auditors, we will have to gear up that we maintain our documentation so robust, sovereign system so robust that each disclosure or each reporting has been made, has been documented well. So coming to this reporting requirement, which talks about relationship with stuck-off companies disclosures. So what is the expectation here is that with any companies, so any companies, not firm or proprietary concern or those kind of entities, or even for that matter LLPs, the reporting requirement here is for any companies who are under the category of struck off and the company has transactions with them, then the company has to report the name of the name of struck off companies, what kind of transactions we had with those struck off companies, what are the balances outstanding as on the balance sheet date with this struck off companies, and what is the relationship with this struck off companies. So the questions now come here with this reporting requirement is, one, whether any previous year data is required, also similar, or rather any previous year's reporting is required in the similar template. The answer is yes, as we discussed earlier, that all reporting requirement in general will be applicable to comparative periods also. The next question which comes here is, or rather I would want to address this first. So the transactions which are supposed to be reported is investment in securities, meaning we have invested somewhere in some company and that company is now struck off, or whether we have transacted or sold to some companies which are struck off, or payables, other balances. Now, this is one area which is little unusual to me, and I'm not sure how would this data be used, but as far as my understanding goes, so what it says is shares held by struck off companies. What does this mean? That equity shares which I have issued, my shareholder is a company which is a struck off company. Now, generally, there may not be any risk of financial loss in these kind of categories if my shareholder is a struck off companies. But for all other categories, there could be a risk of a financial risk, such as if the investment in a security, which is a struck off company, the investment is more or less dead because it could be a struck off company, you may not be able to recover the investment. Similarly, for receivables. For payables, the amounts, those showing payables, but you may not be supposed to, when you are not supposed to pay the amount. So for all the other items, there is a relevance or impact on my financial statements. But this is one such item which is shares held by struck off companies. There is apparently no financial, there could not be any financial impact on my financials. But what I could think the objective or background behind this information is, could be that assuming if there is a shareholder which is a struck off company and which is not in existence, then probably at later date, the company may have to transfer these shares to a kind of fund where there is investor protection fund today for dividend. So maybe at later date, they may come up with something for even the shares where the shareholders are not identified. You have to transfer these shares to the investor protection fund. So that is what I could anticipate for these kind of requirements. Coming to next column, which is balance outstanding. So the question here is whether the balance outstanding should be gross or net. What do I mean by gross or net? Is whether the gross amount which is receivable should be reported, or whether the amount which is net after making provision. So there is a possibility that you would have made some provisions in terms of investments, in terms of long-term investments on a permanent diminution, or some doubtful provisions for receivables. Now, whether these amounts should be reported as net or gross, the answer is this should be reported as gross. The other question which comes up is whether if there is nil balances, then what? Whether do you report the line items as the debtors or creditors which are getting nil balances? Again, the answer is yes, because the requirement of the clause is relationship with stock-off companies. So even if there was some transaction during the year, however, the closing balance is zero, you still have to report that entity as far as this reporting requirement is concerned. Relationship. So whatever relationship, assuming if there is a related party with these, if these transactions are taken up, then you have to give the relationship of related party. Could be subsidiary, could be associate, say could be other entities, so on and so forth. So basically this relationship has to be seen from the Companies Act perspective. So whatever is defined in Companies Act, those relationships have to be reported here. Take a scenario where there is no relationship existing as on the year end. Then what do you do? So fine, you may say no relationship per se directly falling under Companies Act, but there is no relationship directly falling under Companies Act, but it is a routine debtor or a payable or a receivable. So those kind of relationships have to be disclosed. So amount outstanding, gross, net we covered, nil balance we covered, relationship we covered. Okay. So the question can come up is what happens to a scenario where if the relationship, or rather the status of the company which was struck off earlier has been restored before the financial statements. So assuming a situation where as on 31st March 2022, the company was struck off, but the accounts are finalized in say 31st May 2022. So between April and May 22, if those status of struck off has been restored, in that case, you may not report that entity as the struck off companies and there is no reporting required. So to say, what does this mean is identification of struck off companies and restoring back. This exercise will not be only limited to 31st March 2022. You will have to keep yourself open until the adoption of the financial statement, say in our case 31st May 2022. So till that date, you have to keep on checking whether you had any relationships with the stock of companies and whether they are restored or not. Then coming back, if there was a stock of company in previous year, but during the financial year, it was not a struck off company, it was restored. So what do you do in case of reporting of comparative years? So yes, you should continue reporting in previous period that yes, in previous year, this was a struck off company, but currently for during the year, you should not make any reporting. So these are the broad requirements as far as struck off companies is concerned. The humongous task which is going to get involved in this compilation is you don't get a composite list of the companies which are struck off. Meaning, for all practical purpose, what companies will have to do is first of all list down all the companies which they have the transaction first, then go to the MCA site, see under master records each of the entities and identify whether these companies are struck off or active. Keep the documentation as on that date that this was generated as on this date and this was the status of that company as on this date. So compilation of this is going to be a huge task because this status keeps on changing recurringly. I mean, today you may be struck off, you may apply to ROC, get it restored. So this status is changing very frequently and hence this will be a really difficult task to compile and do the reporting. I have been told that there are few softwares or there are few vendors which are available in the market, which are working on or assisting the companies on identifying which are the stock off companies and identifying which were the stock off companies but now have been restored. I have not tested so far any of those software personally, but yes, those kind of softwares are available. So this is broadly on the stock off companies. Moving to the next additional reporting requirement is about the current ratios. So now it is mandatory on all the entities to report various ratios. This disclosure is for division 1 companies. Of course, for division 2 companies, also the said ratios are given, except for NBFCs, because those have a typical, or division 3 companies, those have a typical business. These ratios are not there. There are only 4 ratios which are very specifically related to the NBFC, which are mandated there. This reporting required is only for SFS. For CFS, you need not give the ratio. So again, the format in which you give the ratios is like this. You give the ratio. You also have to report the numerator and denominator which you have used to compute these ratios. The ratios for the current year, previous years similarly, and the variance. Now, apparently so far until here, it seems to be very easy reporting requirement. Yes, kya karna hai? Numbers dena hai, percentage compute karna hai. But the difficult or the challenging task comes to here when it comes to variance. So what it is expected that if there is any variances which is more than 25%, there has to be a detailed explanation that why this change. Now, I'm not sure how would one document this reasons for variance. How would one really present or report in the financial statements for this variance? So this is going to be a difficult task again in this reporting. As far as expectation on calculation of these ratios is concerned, it is expected that generally you use the numbers which are apparently available from the balance sheet line item, so that the readers or stakeholders can correlate this data from the financials easily, such that there is uniformity in all the entities following these ratios. However, it is not specifically restricted to that. The leeway, or rather I would say liberty, is given to the preparers and the auditors that yes, assuming you are into a typical industry, I'm just taking an hypothetical example that an entity is a real estate entity. Now, though in ordinary scenario, current ratio would be calculated current assets versus current liabilities. But assuming in real estate sector, in general parlance, it is computed differently. Then you can do those, you can use those ratios and you can disclose that calculation of this numerator or denominator for this current ratio is this. So that liberty is given to the preparers and the auditors that you may not use the standard ratios, but you can still use the ratios which are used as an industry, or generally your investors would be using those ratios this way. So you can use those kind of combinations to disclose this. As I said, all those things are okay. Those are just the numbers, but the important part is variances and the explanations if they are more than 25%. We discussed the basis of calculations for ratios, that you can use the ratios which are generally in common parlance. Your investors, your industry may be pursuing these calculations differently. Your market research and your credit rating agencies also sometimes may be pursuing these ratios differently. So you can use those bases and ensure that you are reporting accordingly. I have just listed the broad calculations. How should they be calculated? These are again forming part of the guidance note. And while I circulate these presentations, this will be there. So I'm not getting into the actual calculations or numerators or denominators. How should they be calculated? Okay. So, so far, any other questions on these two reporting requirements?
Sir, I have one question.
Yeah,
with respect to like generally for the debt to equity ratio.
Mhm.
Okay. CCPS are considered as a part of equity, as a quasi equity in financial terms.
Correct.
But when it comes to Ind AS reporting, it is considered as a liability. When the ratio, when your conversion ratio is not decided, it is upon future possibility.
Correct.
So in that case, how do we as you have given the example of real estate, so how will we
So apparently, if I was there, and since your financial statements are Ind AS compliant financial statements, and because of Ind AS compliant financial statements, you have classified that item as a liability and not the equity, I would treat that as a liability. So again, as I said, the basic expectation from the authorities is that try to link these numerators, denominators as far as from your financial statements. So keeping this spirit in mind, I would use that. However, again, if my investors or if my stakeholders perceive that as an equity and not debt, probably I would use that also. But in general, I would keep it to link with my financial statements.
Because that might impact, since it's a CCPS, the ratio, if we consider as a debt, then it might give a very
yeah,
wrong.
there can be a difference. There can be a difference. So as I said, if you really want to change any formulas, which is absolutely open, what you need to ensure is that you just give a disclosure below that ratio that yes, CCPS is considered as debt or equity, whatever you've done it for the purpose. So that liberty they have given, and hence my worry is calculations may not matter, but my only worry is this variances. I don't know how will one explain. And how much can you explain in the financial statements? कितना बड़ा आप explanation दोगे? एक page, दो page, चार line. See, it is completely subjective. So that will create more challenges.
So that will include unsecured loan, secured loan, both, no?
Everything. So it is talking about debt.
Okay.
So as I said, even for Ind AS companies, the ratios are same, barring NBFC entities. Those ratios are there are only 4 ratios which I have not covered, considering the interest of the members. But we can very well see from that guidance note available. So moving back next to a requirement, compliance with approved schemes of arrangements. Just allow me for a second, please. Sorry, Gaurav.
Sir.
Sorry, members. So, assuming if there was any arrangement done by the company, maybe merger, demerger, so on and so forth. So there is an additional requirement casted on the management that they have to give disclosures whether the effect of this arrangement has been accounted in the books at first place. If yes, whether they have been accounted in line of scheme which was approved by the authorities and accounting standards. So as a practice, what now I have seen is, as far as before these schemes are approved, now even courts are asking the certificate from statutory auditors that whether these scheme which is proposed is in line with accounting standards or no. So in generally, all the schemes which are now presented are in line with accounting standards, and the confirmation has to be given by the management that those accountings which are considered here are in line with those approved schemes. Assuming if the scheme was suggesting some accounting and same is not done, then there has to be, or rather any deviation between the scheme or accounting has to be reported. Also, there is a possibility that scheme may not be in accordance with the accounting standard, meaning accounting standard may be requesting one accounting treatment, but scheme would have considered it differently. Even in such case, the deviation has to be reported that yes, scheme says so, accounting is done according to scheme, but it is not in line with accounting standards. Even those deviations has to be reported. What is the logic behind this? The logic behind this is what law says, that scheme will always overrule the accounting standards, meaning irrespective of whatever accounting standard says, if the scheme has been approved by the authorities or court, example, that as far as accounting standard is concerned, you have to always fair value your arrangement. So you have to record your assets and liabilities at fair value. But as far as scheme is concerned, you would have got an order from the court that fine, you can also book at book value. So it is not in accordance with accounting standard. But as an entity, what will entity do is will record the transactions in line with the scheme, which is approved by the court, but it is not in accordance with the accounting standards. Scheme will overrule, which is law will overrule, and hence even those deviations which are not in accounting standards will have to be reported. It also one has to also give the reporting on in case of ongoing accounting impact. Now, what does this ongoing accounting impact means? I'm sure we members are aware when it comes to Ind AS, actually they give 1 year window of scheme accounting, meaning today, assuming an hypothetical situation where on 1st March 2022, your scheme got approved. Now, until 28th February 2023, you can change or modify your accounting, meaning what will happen is as on say 31st March 22, you accounted for schemes wherein say residual portion you accounted for goodwill, meaning you have not identified the specified intangibles which were available from that company. Now in June 2022, you realized, oh, there was an intangible asset, meaning you had to account for intangible, consequently your goodwill will go down. Now, those kind of modifications are permissible in Ind AS. So this is an ongoing accounting impact, 1 year window. So until 28th February 2023, you can change your accounting, you can change your assets value, you can change your liability value basis the information available during the next 1 year. So if you are into that period, so as on 31st March 2022, you have not completed that period, you have not finalized your scheme accounting, even those disclosures have to be given that yes, and this is what it means. This ongoing account impact means that your accounting is still to be concluded and those reportings have to be managed even in this reporting requirement for schemes. There is one such one cosmetic change which is done earlier. It was fixed assets in the face of the balance sheet. Now they have changed it to property, plant and equipment and intangible assets. This actually should have been done before only, but they have done it now. This tangible, intangible assets is now PPE and intangible assets. This is in line with the change in the accounting standard name 10, because 10 earlier was fixed asset, then which was renamed to PPE. So these changes should have been done that time. So this is a cosmetic change. Another very important aspect which is changed in as far as property, plant and equipment or intangible asset is concerned, that now onwards all revaluation of or rather any assets which are revalued, you have to give those disclosures in terms of addition, disposal and so on and so forth. So basically all the information related to revaluations have to be reported in financial statements. Now, reporting requirement per se is for only and only if that revaluation is more than 10% in aggregate value for each class of asset. This is what is the requirement of Schedule 3. However, for all practical purpose, this may not change our working, because accounting standard 10 in any case was expecting this information, and in fact the requirement of standard was much higher, because this 10% threshold was not there in accounting standard. Accounting standard wanted all revaluation details to be given. So again, I treat this as a more or less cosmetic change, because this really doesn't change the way we were already working, because any revaluation AS10 was already expecting more disclosure than which we had been complying with. However, the question comes here is that how do you disclose on year? So meaning, assuming in current year, you had given a column which was showing revaluation details. So the next year, do you still continue to show that column? No, it gets merged with your opening balance, and hence next year you will not show what was revalued earlier year in general. So basically this reporting requirement is for the year, any transactions or any event which has triggered during the year. So this was another, I would call it as a cosmetic change for me, because accounting standards are already giving requesting more disclosures. one important disclosure under this category is you have to mention that whether this revaluation was done on the basis of valuation by registered valuer. Now, let me clarify that there is no mandatory requirement as far as revaluation is concerned that you always have to have it with registered valuer. It is just a disclosure requirement that you have to mention that it was whether by registered valuer or no, but there is no mandatory requirement. So, of course, as I said, if the company has not used the registered valuer, then the fact needs to be disclosed. CFS, okay. So when you are preparing CFS, in addition to all the above disclosures, you have to mention the fact that which entity these revaluations were done, what type and nature of assets were revalued, and again, there also whether the revaluation was based on the registered value report or otherwise. Any questions so far?
I have one with respect to merger.
Yeah.
So let's say the scheme was proposed in the end month, let's say in Feb or March. The court proceedings are going on and the cutoff date is set as 1st March. We had finalized the books on, let's say, 31st May, but the order is not yet passed by the NCLT. So how will we account for that? Because the cutoff date is 1st March and we had already finalized our books.
This is actually altogether a different subject. We can discuss this for a couple of hours on this. But let me just summarize. Let me just summarize in two aspects. One, you will have to see what accounting you are following, whether AS or Ind AS, because the treatment in both is different. See, what happens is in case of AS, you go by way of appointed date, and when it comes to Ind AS, you are looking at the change of control date. So there is a possibility that between both these two scenarios, your accounting could be on the different dates. Hence, this will get a little complicated. But apparently, since that I'm assuming that you are into AS, I'm assuming that you have already finalized and you have the approvals or the courts have not approved this scheme. For March 22, you would not do anything. March 23, once you have this order, you will account with effective date, which is say 1st March. So your disclosures will change in your P&L. In your P&L, profit of that 1 month will be shown as a separate line item. Of course, in your balance sheet, this gets consolidated line on line. But in your profit and loss account, that 1 month profit which gets accrued to you as a new group will be shown as a separate line item. However, when it comes to Ind AS, now I'm assuming that on 1st March, you effectively got the control. Okay. So you yourself only are functioning now that entity. Now, irrespective of whether the court order has come or no, you will have to do business combination accounting as on 31st March 22.
And similar disclosure will be required.
Sorry?
And similarly, when the order is not yet passed, disclosure will
be... Of course, because you have already accounted for. Of course, because you have already accounted for. So hence, there's this demarcation between AS and Ind AS companies. Ind AS talks of obtaining the control. So they are not concerned. Let me digress little then this subject. So in case of Ind AS, your consolidation is absolutely not dependent on your shareholding. So even if there is a situation where even if you are not holding even one single share, and there can be a possibility that you are consolidating so many other entities, because the basic definition there for consolidation is they are controlling those entities. And I'm assuming in this case of situation where you have mentioned, you must have started controlling from 1st March, and hence you need to do the accounting. Whereas in under AS situation, this may not be true.
Thank you, sir. So we have a query in chat box. How to report revalued land subsequently converted into stock in trade?
How to report revalued land subsequently. So this is only talking about revaluation of PPE. So when you have revalued the PPE on that date, you have to give those disclosures. So I'm assuming when you have revalued the land, it was a PPE that day, and these disclosures are applicable. When it comes to conversion of stock in trade, of course, that will follow a normal presentation in terms of it will be a deduction from your PP and you will convert that into stock in trade, or you will start showing that amount in your inventory.
Hello.
Yes, sir.
So, sir, revaluations done in earlier years prior to this year, whether they are to be reported or
So, only revaluation done for previous years will be reported because you are giving the comparative figures.
And in next year also, we have not to report anything.
No, unless it is required by accounting standards. But as far as Schedule 3 is concerned, no. So as I said, reporting requirement of standards will prevail over Schedule 3. And hence, whatever we were, as far as this typical amendment of revaluation of PP is concerned, whatever we were following for accounting standards will have to be continued, because there was no threshold or limit as far as revaluation value is concerned. In Schedule 3, they have still given a threshold of 10% revaluation, that if it is that way, then only you give the information.
Okay. And can I request one thing? Whatever the amendment we are talking, if any amendment is not applicable on the small companies, please highlight that.
Sure. But sir, all these amendments are applicable to all the entities. Huh? So Schedule 3 is not giving any leeway. Now I was actually discussing with one of my other partner last week, a classic example. When it comes to Caro, it is not applicable to small companies. Hence, you are relieved of a lot of reporting, but these amendments are applicable to all entities, irrespective of the size.
So including all small company and one man company.
Yes. OPCs, small companies, everyone.
Thanks.
So with we move to next amendment. Again, this is a cosmetic change. Now I will explain this logics. So earlier, when it is security deposits were disclosed under long-term loans and advances, now they have to be non-current assets. Gaurang, we were discussing this on ratios. See, what used to happen is security deposits or few other cosmetic changes like this. There is one change when it comes to maturity of long-term lease or current liability portion of long-term borrowings. We used to show in other current liabilities. What used to happen is the moment you show that amount as other current liabilities, your ratios were getting affected. Ideally, that was not a current liability from the perspective of ratios, because it was actually a part of my borrowings. It was a part of my debt. But for the sake of simplicity or for the sake of requirement, we were disclosing that is a part of current liabilities. Even there also, those cosmetic changes have been done. Now they are saying that in case of current maturities of long-term borrowings, you have to show that as short-term borrowings and not current liabilities. So keeping in line with these ratios calculations and how the industry was perceiving these ratios, these few cosmetic changes have been done, like this classification of long-term loans and advances, security deposits. This was one such change. Okay. Coming to again a huge task of reporting as far as trade receivable is concerned. Now this trade receivable and trade payables are a replica of each other, barring few changes, which of course I will discuss. So until now, as far as trade receivable is concerned, we were only reporting receivables more than 180 days and less than 180 days, between considering good and doubtful. Now the requirement is you have to give the aging less than 6 months. Sorry, I will start with not due, less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and then this total, which has to match with your balance sheet. So the scope has been expanded only from 180 days and other than 180 days to so many categories. One. Second, this reporting has to be done from the due date of payment and not the invoice date of payment. Challenges for one client, you may, or one customer, you may have 15 days due date. For another customer, you may have 30 days due date. For another customer, you may have 90 days due date. So there will be a lot of challenges. Now here, actually the technology has to play a role. Technology should give you the details as required under each class of categories. There is an additional column, or rather a disclosure on unbilled part. So any amount which is unbilled and receivable under each of these categories also has to be reported. What could be unbilled? Now, assuming a service sector, rather assuming we a professional, and I am following, of course, for all practical purposes, we must be following cash accounting system, but assuming that I was following an accrual system or a mercantile system. Now, for an entity, I have done the audit for say interim period. I have not billed it. I'll have to disclose those amounts here. That these are the values which are services are provided but not billed, unbilled. So this will be a challenge. Now, in case of non-service organizations, situation which I can anticipate where these amounts would be coming is goods delivered but not invoiced. But this is a theoretical situation. Practically now with this GST in line, each of your movements have to be along with the invoices. This situation may not be more relevant or more practical, but yes, any exceptional situations where you have provided the goods, delivered the goods, provided the services, but the invoice is pending, then you have to report under these categories. Coming back to very important further sub-reporting is between undisputed and disputed. Again, a challenging task. What do you call undisputed? What do you call disputed? How do you document this? That on what basis have you reported this or classifications have been done? The question is, assuming a customer has confirmed that these balances are payable by him and receivable by us, but they had not been paying for more than say 5 years. Where do you classify? Those are undisputed, disputed. So my answer to that question is that these are undisputed because the customer has agreed to pay, though they are not coming for a longer period, but they are acknowledging the fact that yes, these amounts are payable. So a lot of subjectivities will be now involved in classifying each of the debtors. Now the example which I gave, there was a specific confirmation from the customer, but there can be a scenario where there may not be the specific confirmation from the customer that which are outstanding for more than 5 years. What do you do? Whether they are disputed, non-disputed? The answer is difficult to answer in one line. You will have to see the facts and cases of each such transactions and accordingly classify this. Now, the relevance of this disclosure, another important disclosure is, now basis this disclosure, now there will be a lot of questions asked by auditors to the management, by stakeholders to the management and the auditors. Meaning, if assuming there is some amount which is reported more than 3 years or within the block of 2 years, 2 years, 3 years. Now, apparent question which I will ask management is whether the provisions for these amounts have been done or no, whether these amounts stands to be receivable or no. So there are a lot of such questions which will arise or which have to be raised even by the auditors once these further disclosures are disclosed by way of which are reported in reporting as a part of Schedule 3 disclosures. So we discuss what is due date. So what happens to a situation where there is no specific due date? Then in generally transaction date or the invoice date will be assumed to be as a due date, and you will have to report your disclosures accordingly. Now take a situation where if there is a negotiation of due date, then what do you consider? Whether this renegotiated date should be considered as a starting point for due date or the original invoice has to be considered. So again, that will have to be seen on case-to-case basis, whether that renegotiation was a principal renegotiation or it was merely a procedural renegotiation. If it was a principal renegotiation, then that becomes the starting point. Otherwise, your original due date becomes the starting point. So one will have to be careful at each line item, what kind of due dates you are considering. Dispute, we did discuss what is disputed and non-disputed. And aging, we said that yes, all this aging will become an indicator for accounting of impairment or provisionings, and what kind of impairments or provisionings you are doing for these old due items. So the questions will come there. Similar requirement what we discussed for trade receivables is for trade payables, except for one small change where instead of, additional requirement will be for MSME and non-MSME categorization there further. We will cover there at that time, but this is what is required for trade receivables. Any question on this trade receivables?
Yogesh.
Yeah.
Sir, in trade receivables, generally on the invoice, there is nothing, repayment
Due date mentioned.
Due date mentioned, but generally in trades, people do grant 15 days, 20 days, depending upon the industry to which you belong. So how do we?
So my view there is, since there is no specific due date mentioned, of course, as an industry practice, there is a 15 days, but I would consider this aging from the transaction date, which is invoice date, because theoretically that amount is due there and there itself.
Okay, because in banking transactions, in banks and everywhere, we have to give aging. So in case there is any due date which is mentioned, so there will be lot of
yes,
reconciliation which would be required in that.
Yes. So that's what I said. Apparently, the requirement of this provision seems to be कि क्या देना है, खाली aging ही देना है ना. But ये एक aging से इतने सारे और further questions खड़े होंगे. And as I discussed, कि थोड़ा भी पुराना aging है, तो you as an auditor only will question whether there is a need to provide, not to provide, whether you need to impair or not impair. तो ये Pandora box खोलने वाला है. ये reporting simple लगता है. बट इसके पीछे के बैकग्राउंड क्वेश्चंस जो फॉर्म होंगे विल बी अन अमंग अस टास्क का. बट यस, यू राइटली सेड, आपने एक जगह एक यूज किया होगा रिपोर्टिंग के लिए ड्यू डेट्स और दूसरे का कुछ और यूज करेंगे, तो there will be a questions. But as an practical way out, rather what I would suggest is try to be consistent everywhere. Assuming for bank purpose you've done or you've taken some different view in terms of reporting, probably use that basis here also and disclose it that this is how you've done the reporting. So ultimately, as you remember, Durgesh Kabraji was referring in his opening remark that try to be as transparent as possible. Whatever assumptions you have taken, bring it to the stakeholders that yes, on basis this you have made. That is how we are going to increase our value as an auditor's fraternity in the eyes of stakeholders.
Thank you, sir.
Last year, 51.
So moving to this important reporting requirement once again, that in case of immovable properties, whether the company is holding the title deeds in their name or no. So very factual information again here, but very relevant information that there are possibilities that in many entities, they must be holding the properties, but the title deeds may not be in their name. There could be genuine reasons for doing that, but now those have to come up from the face. आज की तारीख में हम financials देखते तो हमको ये information मिलती ही नहीं थी as a stakeholder, as an investor. Again, as I said, in trade receivables, यहाँ पे भी there can be a question कि अगर जो आप आपके नाम पे hold नहीं कर रहे हो, तो what is the reason? Whether there is a dispute, whether you have a clear title, आप clear title नहीं है आपके हाथ में, फिर भी आप asset बता रहे हो, whether you are going to recover that asset. So all these additional disclosures are really going to lead so many additional questions on the management. Of course, all these questions, while we were auditing, we would have questions. But now, since this will become a public document, these financial statements will become a public document, even stakeholders will have access to this information. Bankers will see this. आपने एक land and building mortgage दी हुई है, उसका title deed आपके पास नहीं है, clear title नहीं है आपके पास, reporting यहाँ आती है, bankers will question, अरे title deed क्यों नहीं है? This is just an example. Of course, title deed bankers would know because when they take the mortgage, they will ensure that those are in your name. But barely by disclosing so many things, there will be a Pandora box opened when there can be so many questions asked based on the information available in the public domain now. So coming back to this specific requirement, it talks about which category of asset it belongs to when it is relevant line in balance sheet. So it is PPE, investment property, or PPE which are retired from active use. This is a category of asset held for sale category in case of Ind AS entities. You have to give the description about the property, whether it is land, building, so on and so forth. You have to give the gross carrying value and not the depreciated value. It is gross carrying value of the asset. Title deeds are held by whom if they are not in their name. whether the title deeds are held by the promoter, director, relative, so on and so forth, what kind of relationships you have. And if those are relationships related to Companies Act, you derive the definition from there. Since what date you are holding these properties, and reasons why these are not in your name. Now, apparently, there could be few reasons which I could think why they are not in my name. Could be there could be a documentations which are under preparation, registration is under process, could be some dispute, could be demerger, merger situation, wherein last year only you have done this arrangement and now you are in the process of getting this rectified. So these are various possible reasons where one may not have these properties in their name, and those reasons have to be disclosed properly. There could be another typical possibility where one may not have the properties in your name is agricultural companies. Now, as all of us know, that agricultural land cannot be held by a legal entity or a person other than the individual. So all these agricultural produce companies, what they practically do is, though all the payments would have been done from the companies, the land would have been recorded in the books of companies, but they must be holding in the name of directors or promoters. This is one classic example which I could also, in addition to the list which is mentioned here, I could think that yes, there is a possibility that ये situations में भी ऐसा हो सकता है. Relative, we discussed, you have to look at Companies Act definition. Immovable property is not defined, but yes, you look at the general terminology, what is immovable property. Title deed is not necessarily, it could be a legal document. Even, for example, allotment letter is as good as a title deed, which if it is in your name, you can consider those to be as legally in your name. What happens in case of a situation where the property is jointly owned? So all these disclosures will be required only to the extent of entity shares and not the whole property. Typically, if the property is held by way of immovable property, by way of an inventory in case of real estate companies, so whether these disclosure requirements are there, though the answer is no, they are not there, because the reporting is only for the assets which are held as PP and not the inventory items. What if the dates are not available? Generally, this would not happen, but if they are not available, then the nearest available date is what you should mention, which is a month or the year. Okay. Next disclosure is loans and advances. Otherwise, fairly a simple reporting requirement that any loans which are given in the advances which are given in the nature of loans have to be now reported for these types or these categories of borrowers. So, for example, now if you've given any loans to your promoters, you have to show it separately. To your directors, you have to show it separately. To your KMPs, you have to show it separately, and related parties, which otherwise also we were seeing. But now that you have to show it separately for all other categories. Reporting requirement is, as I said, loans and advances in the nature of loans. So genuine business advances are not required to be reported here, is one way you have to be careful. The classification of these, sub-classification of these loans have to be done by repayable by demand, repayable on demand, and repayable without specifying any specific terms. So there is a possibility that we would have given loan, और ये होता है, हम लोन देते हैं या अनसिक्योर्ड लोन फैमिली मेंबर से लेते हैं, रिलेटिव से, डायरेक्टर्स के रिलेटिव से, डायरेक्टर से, तो generally there are no specific terms. So if any such loans are advanced in that nature, then you have to report in these two broad categories, which is repayable on demand and without specifying terms. You have to give the percentages of these reported numbers in terms of total loans and advances which are outstanding as on the date of balance sheet. Now the question here is, these categorizations, promoters, directors, KMPs, related parties, you see as on which date? So this has to be seen as on the date of transaction, which is assuming आपने 1st March को डायरेक्टर को लोन दिया और 31st March को डायरेक्टर नहीं है वो, तो क्या करेंगे आप? रिपोर्टिंग करेंगे या नहीं करेंगे? The answer is करना पड़ेगा, because on the date of loan the person was director, and hence relationship has to be seen as on the transaction date and not at the closure date or at the balance sheet date. Disclosure again is gross versus net. So you have to give the gross disclosure, not the net disclosure. Net, what we mean is again the provision or impairment, if any. And any loan which is in the nature of business advance or related to actually business will be classifying as an advance and not as a loan. Now one have to be careful. Sometimes some may take a color a transaction in such वो apparently business advance दिखे, but it may not be. For example, generally आपकी industry practice advances देने की होती है PO का 20% say for example, but you would have given 100% advances. I mean, in that case, I would treat that 80% excess as a loan and not a genuine business advance, because that is not the industry practice. So any advances now onwards, you'll have to be careful that as an industry, what kind of business advances you are giving and whether they are advanced genuine or they are in the nature of loan. And if they are in the nature of loan, you have to cover under this disclosure. Before I come to this, again, any specific questions on earlier clauses?
As regards these loans given, whether like data, the information of aging is to be given?
No. So it is purely under this format, that what kind of borrower it was, whether the loan was payable on demand, repayable on demand, or which was without any specific terms and percentages thereon. That's all.
Okay.
So no aging is required. So let me go to one of the other important reporting requirement of aging in connection with capital work in progress, intangible asset under development, and investment property under development. So again, any assets within CWIP or intangible under development or investment property under development, you have to give aging for amounts outstanding as on balance sheet date into these three categories, which is less than 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. There is a further sub-classification required for projects in progress and projects temporarily suspended. Now, again, a lot of questions will arise here. Let me first address the questions which can come is of this aging categories. Assuming the management has classified a project in progress, but with more than 3 years, the immediate question comes is whether any impairment required or no, or whether any provisioning is required or no, because, or rather, whether the entities are generally into these kind of projects which generally take more than 3-4 years or 2 years or 1 year. So those questions will come up when it comes to projects in progress is concerned. When it comes to project temporarily suspended, the immediate question which comes to my mind is assuming this is a long project, and if it has been suspended for a long period, which was outstanding for more than 3 years, but it is the management says that it is temporarily suspended. Then the question comes whether again any impairment or provisioning is required or no. I go back to borrowing cost standard and correlate there, whether any interest capitalization has to be suspended there or no, whether they have been still continuing with the interest capitalization even though the project has been suspended. So again, as I said, the moment there is some information, basis those information, there could be so many questions arising on various other aspects. So as an auditor now, one will have to be keeping its ears and eyes open कि अरे ये कोई प्रोजेक्ट सस्पेंड हो गया है 3 साल से पुराना है, क्या इसको इम्पेयरमेंट की जरूरत है? नहीं है. Of course ये सारा हम एक्टिविटीज पहले भी करते होंगे, but now that this is coming up in the public domain record and this is available to public at large, stakeholders will definitely question further, because background information they don't have. You would have a lot of other working papers basis which you would have decided that yes, this is a suspended project, but it does not need any provisioning, but this is not available in the public. So my apparent view is any such questions which generally would arise, could arise basis this information, one should try to give a fair disclosure कि हाँ, though this is appearing for more than 3 years, but no provisioning is required because this was suspended only on account of this and hence no provisioning is required. So disclosure requirement काफी सारे बढ़ जाएंगे in these kind of reportings. Aging, how do you determine? So it is from the date of initial recognition of those projects to the balance sheet date. For this reporting, whether you report project wise, the answer is no. Here, for this aging purpose, you only have to classify between project in progress and temporarily suspended. Project wise reporting requirement is there in the next reporting requirement, which you will cover. Changes at the end of current period as compared to previous period, what should you do? So for example, previous year में वो in process था, अभी suspend हो गया, तो इस बार तो आप report करेंगे under suspended category, but what will you do for previous year? Whether you classify that also as regroup that also under suspension category? No, because as on that date it was in process, so you continue there, and in current year you show it to be suspended, and vice versa. This is what you have to ensure. So we have already discussed this. Now coming to the provision which requires whether you have overshot the timelines or whether you have overshot the expenses when it comes to your budgeted expenses. So one small change as compared to earlier clause. Earlier clause was requiring information for capital work in progress, intangible under development, and investment property also. Now this reporting requirement is only for two clauses, capital WIP and intangible. It is not required for investment property. Here, assuming if you have overshot your due dates, so you had planned for 1 year that your project will get completed in 1 year, but this end of 3 years also and it is still not got completed, or you had planned for say 100 rupees as an budgeted for this project, but you've overshot for 200 rupees. So ऐसे सारे जो projects हैं which has to be reported under this table. Now here you will have to give project wise. So project in progress, within that you have to give sub class project subcategory of project 1, उसकी aging ये है, इसकी project 2 की aging ये है, suspended category में project ये so and so forth. So that was only merely the aging of all the CWIPs. Now in this case, reporting will be only and only the categories where the original plans have overshot by way of age or by way of cost. एक example लेते हैं कि as on March 2022, there is a CWIP which is only completed 6 months, which is in line with the cost or age. So there will be a reporting under this clause because this is merely a reporting of CWIP as on date. But since that has not overshot the budgeted timelines or budgeted cost, there will not be any reporting for that project here. So again, one has to be careful कि सारा reporting यहाँ duplicate ना हो जाए, यहाँ पे जो reporting requirement है वही आए, और यहाँ पे वही reporting आए जो आपके timelines और costs overshot कर चुके हैं, and again the reporting will be project wise here. Further subclassification of asset wise is required under this. No, it is required by project wise. You have to stay to project. Timelines, yeah, deadlines, yeah, cost. When you say those have been overshot, how do you determine that? आपका एक ओरिजिनल प्लान था, अगर जो आपने वो प्लान को रिविजिट किया है और नया डेडलाइंस रिविजिट करके नए डेडलाइंस बनाए हैं, तो जब चेंज और दी रीनेगोशिएटेड टाइमलाइंस as we discussed in trade receivable, if those are principal changes, then you treat the new dates as the deadline starting point. Otherwise, your original plans remains the starting point for these calculations. Any questions on these?
So we have a question in chat box. Is reporting required for capital advances in line with capital work in progress?
Again, I will classify into two parts, AS and non-Ind AS companies. When it comes to Ind AS companies, even capital advances are expected to report as a part of CWIP schedule. So there, yes. But in case of Ind AS, you are generally reporting those advances as a separate loans and advances. So the answer is no in case of AS companies. So let's move on to next Benami property. More of a cosmetic, rather I would not say cosmetic, but more of a factual based information. So if the company, if any actions have been initiated on the company on this Benami Transactions Prohibitions Act, and you are in a possession of information that as an auditor you came to know about this, of course, as a management, they have to disclose. But if you come across any such situations, then you have to insist upon management that yes, these actions have been initiated, and if they have not reported those details, then you have to insist upon management that they should be reporting this information under Benami property held. So the basic requirement of this reporting is what kind of properties or you are holding. So details of such property, which is mainly name, nature, and year of acquisition. What are the amounts involved in this Benami property? Who are the ultimate beneficiaries? The details of those beneficiaries, their name, address, relationship with the company, and any government registration numbers, which could be PAN, Aadhaar, SIN, so on and so forth. Whether these properties are recorded in the books of balance sheet in the company. If yes, then you have to draw the reference to the balance sheet line item. If those are not recorded in the books of companies, then you have to mention the reasoning of why they are not recorded in the companies. Details about the initiating officer. So whether the proceedings have been initiated as an abettor or as a transfer, then the properties have to, the details have to be given under this column, and who was the initiating officer, show cause notice, and so on and so forth. And finally, what are the nature of activities, or rather what are the nature of proceedings which are prevailing in the name, which are initiated in the name of company? The details have to be given, and at what levels they are lying. Whether whether there was an attachment, whether there is an adjudication done, whether the property is confiscated or no. So these factual informations have to be given. Now, broadly, one has to understand that initiation of this disclosure apparently has to be from the management side, and basis the proceedings initiated by the authorities under this Benami Transaction Prohibition Act. This is one has to keep in mind. However, there could be a possibility that you may come across as an auditor that there is some Benami property transactions held or company is involved in any such transaction, and then you should insist on those reporting requirements also. But for all practical purposes, let me be very honest, this one will not come across such situations, or one may not be having access to those informations. We discussed that the primary responsibility is on the management, and if auditors comes across any such situation, then they have to insist upon these reportings. There could be a lot of practical challenges which one has to consider while reporting. So there's a possibility that sometimes beneficiary details may not be available. There's a possibility that their properties may be out of books. How do you know as an auditor? But as I said, the primary responsibilities lies with the management. So one has to believe them, unless there is some specific information which is available to auditor from which you can make out that yes, these actions have been initiated and those have not been reported. So more of a factual based information. So I think this was broadly on the asset side of the disclosures. Now coming to liabilities side, fairly simple reporting requirement that until now a lot of other, in addition to other reportings in terms of equity, share capital, now we'll have to also give the holdings which are by the promoters. So you have to give the name of the promoter, number of shares, percentage of total holdings what they are having, and percentage of change as compared to previous year. So this leads to, meaning this information, though technically not required by Schedule 3, but you have to also give previous year data here. So your this change percentage columns becomes relevant. One can easily compare as compared to previous years. So the disclosure requirement for this should be done for each class of shares. Percentages we discussed. Meaning of promoters, generally we will get this information from the MGT7 filed by the company, because in MGT7 company has to declare who are the promoters of these companies. So that is where you get the information that who are the promoters for this reporting. For the companies which are in the process of listing, even you get it from prospectus. Otherwise, the people who have control over the affairs of the companies get the those becomes the promoters in that category. So one has to check first who are the promoters, and accordingly, this is reporting has to be done. Fairly simple reporting requirement. So this was one discussion which I was having earlier, that until now, current maturities of long-term borrowings we used to disclose as other current liabilities. Now they have done this cosmetic changes that this has to be done as short-term borrowings and not other current liabilities. Again, the logic or idea which I could follow is, since being a borrowing, you were classifying this as an other current liability. This was impacting my current ratios, and hence this has been removed from there, and now this has to be classified as short-term borrowings. A cosmetic change. Trade payables, we did discuss that the aging reporting requirement is similar to trade receivables. So less than 1 year, 1 to 3 years, so on and so forth. Again, you have not due categories and unbilled categories. Except for disputed and non-disputed, as I said, additionally, what was required here is for MSME and non-MSME vendors. So this is almost similar requirement as far as trade receivable is concerned. And as far as categorization of MSME and non-MSME vendors is concerned, we are already used to this reporting requirement, and we had been doing since ages. Due date, the logic remains the same. If no due date, again, the logic remains the same. And if disputed, non-disputed, the logic remains the same. Okay. So any questions so far on whatever we discussed, the remaining clauses?
I have one question.
Yeah, right.
So with respect to the trade receivables unbilled amount, it should match with the revenue of unbilled revenue which we have booked.
Yes.
So what will be the respect with the creditors?
Similar. So there could be a possibility. Again, I was discussing that time receivables. Okay, goods delivered but not invoiced. So there could be a possibility that you would have received the goods, GRN would have been done, you would have consumed the goods, but there would not be any invoice from the vendor. So just because there is no invoice from the vendor, definitely not necessary. I mean, you would still account for it because you've already consumed those goods. So this will be like goods received but not invoiced category. For payable receivables, you will be saying unbilled category, but here uninvoiced category.
Loda sir, your voice is not audible.
Sir, I think your
Loda
voice is
sir, your voice is
cracking.
not clear.
If you can just post your question on chat box.
Okay.
Till that time, Gaurang, can we move forward?
Yes, sir, we can.
So once Mr. Loda posed the question, we will address that. Very important, practical and relevant updations, amendment with regards to borrowings and borrowings which are against the current assets, and which this we will face day in, day out. Meaning, so any the companies which have borrowed the money, which is in the form of probably OD and CC, because that is what practically for all purposes will happen, against the current assets, meaning hypothecation of stock, debtors, and so on and so forth. So if the company has borrowed from banks or FI on the basis of securities as a current asset, again, I'm repeating, assuming if the assets given for hypothecations are immovable properties, or rather non-current assets, then this reporting requirement is not there. So this is purely for borrowing which are against the current assets. In such case, generally there is an obligation on the borrowers that they would have filed the quarterly returns or current statements with the bank. The reporting requirement here is that those, say, debtors or inventory statements should be in agreement with the books for that quarter or for that period which the company has submitted. Now, assuming a situation, if those are not matching, then the summary of reconciliations, or rather we have to explain the deviations and reasons for those discrepancies have to be given. The format in which this information has to be given is quarter, which quarter you are referring to, which bank, what are the securities which are provided, what was the amount as per books, what is the amount as per statement submitted to the other banks, difference, and reasons for difference. Simple format. The questions are now come. The question comes here is whether this reporting requirement is for the borrowings which are outstanding at the year end. The answer is no. Similar requirements are in CARO, and CARO it is referred that amounts have to be outstanding any point during the year. So we have to draw the analogy similar here, as it is not specifically clarified in Schedule 3, but we have to draw the analogy, and for any point during the year, if the amounts were outstanding, we have to give this reporting. Again, so far it is good here. The principal question which will come here is, what if the entities who are submitting these details are not preparing the quarterly financial statements? What do you do? How do you compare this data? So practically, I think this question now becomes more of an academic or theory question, because practically we cannot say this as all the entities are following GST. Under GST, you have to maintain the inventory records. You cannot say that you have not maintained the inventory records, and you cannot take a plea while reporting here that the entity has not maintained any quarterly record or quarterly financial statements. Hence, for all practical purpose, I do understand that there are many entities who may not be formally preparing the financial statements, but one will have to find out a way to report under this category, under this para, and will have to be in sync with all other laws which are applicable, which mandates that you have to maintain the regular books of accounts. A leeway in terms of not necessarily that you have to have prepared the quarterly financial statements to derive these numbers. Even quarterly finalized trial balance should be okay to comment that whether these data or these numbers are matching with books of accounts. Some few incidental questions along with this is whether this sanction. Okay, so this reporting requirement is in connection with sanctioned borrowing. So there could be a possibility that there would be a sanction, but you may not have utilized the funds. So what do you do? Whether reporting is required or no? Yes. Even for sanctioned borrowings, and irrespective of whether you've utilized the funds or no, this reporting is required. Does this applies to fund-based, non-fund-based, or both? So it applies to both. Even if you may not have fund-based, but you may have only non-fund-based, then you are still supposed to report under this category. Assuming if the management is submitting monthly returns, you give this reporting for monthly or quarterly. The answer is clearly quarterly. Irrespective of whether the management is doing monthly, bi-monthly, or whatever, our reporting gets restricted only for the quarterly periods. There could be a possibility where one would have borrowed from the current assets of, say, holding company. The guarantee would be current assets of the holding company and not your current assets. In such case, whether the reporting is required, yes, the reporting is required, because the requirement is borrowings against the current assets. It is not restricted to the assets of the entity, any other entity's current assets. we already covered that if those are against non-current assets, then whether reporting required, then it is not required. Any specific question on this paragraph or this clause?
Sir, my question is, the company is maintaining stock ledger in terms of quantity, right?
Correct.
Say in June quarter, the quantity is 1,000 tons.
Mhm.
The company has submitted stock statement of 1,000 tons.
Correct.
Now, in terms of value, we are not having any particular costing or valuation. They are giving just as per last year, whatever valuation is done, they are giving as per that valuation, they submit it to the bank, 1,000 tons at the rate of 1,000, it comes to 10 lakhs or whatever. So how to tally this, whether we can, our client is doing that 1,000 tons multiplied by 1,000 tons, they make one entry in June quarter, then they reverse it in July 1st July, and they are maintaining in this way. Because the quantity terms it is telling. Only the problem is with value terms. So how can this be solved?
So apparently, I mean, I'm happy to at least hear that your client is actually entering some or other value in the system and giving. Practically, there can be many clients who may not be deriving any value only. They would be just giving the quantities, or other they would be putting the values while submitting to the bank, but those entries would not have been done books of accounts. So, answer to specific question which you have raised, that they've adopted the value which was used for previous years. Management has adopted those values, but when it comes to auditors, because see, we are ourselves also finalizing the certificate, signing the financial statements. You'll have to be really cautious in terms of keeping the working from the management to maintain that value, whatever was adopted, is also similar, which would have been this period also. So as I said, you'll have to come out with a way out wherein you are obtaining some documentation or some valuation paper which are created for that specific date.
Okay.
But if nothing such like is available, then probably you have to give a disclosure that these values for this purpose of books have been arrived basis previous years.
If it is not say it is ad hoc,
then you have to definitely clarify that this is ad hoc. You cannot take that responsibility of certifying that this was the right value as far as your books is concerned.
okay. So we can say it is on the
Arunji, this is technical side. Arunji, this is technical side. But one will have to sit with client, practically try to find out some way out in terms of keeping some documentation to justify those values. Because this is the precise reason why they have put this reporting requirement. There are entities who had been overvaluing their assets, submitting it to bank, ensuring the higher DP, and then after 2, 3, 4 years, ये bubble बड़ा हो जाता है and these accounts becomes NPA.
Yes, I understand that. Yeah.
To club all this reporting, to curb all these reporting requirements have come. So you have to give justice to this. And as I said, as an auditor, you have to ensure that some or other form of documentation is available to you to justify your documentation.
So we have to disclose the method of valuation over there. The client has adopted this method to.
If you are not concurring or agreeing with the value which is reported in there, then yes, you will have to disclose the method of accounting.
Okay, what you advise in such cases, the proper valuation has to be done by every quarter?
Ideally, yes.
Okay.
See, as I said, between the lines, that you have to ensure that you have some or other documentation which would justify this reporting. Otherwise, you will be in trouble as an auditor.
Okay. Thank you, sir.
Because first thing, peer reviewer will come and ask these kind of information. And I have faced these peer reviews. I have faced QRBs. So for one of my QR listed client, we had faced this QRB, and the kind of questions they ask, I mean, literally you will be sweating. I'm telling you, if you don't have those documentations.
Okay.
And you will face tough time.
Okay. If it is as per last year, we have to mention it is taken as per last year's costing.
Yes.
Okay.
Sir, overdraft or CC limits taken against the FDRs of the company or associated company, whether to be reported?
No, because those are not your current assets in the nature of what is expected here. So basically here what they are looking at is debtors, creditors stock, which you really manipulate those numbers for having your DP. So those kind of assets is what they are looking at. When it comes to FD, there's very clear case. I mean, generally you will not be able to manipulate DP there.
Yeah. Thank you.
So there is one question, what if book value is more than the stock statement? Irrespective. So you just have to give the disclosure that in 2 columns, what is your book value and what is your submitted stock statement. And if there are variances, then you just have to reason if those are material. So this is the reporting report. Gaurang, how much time do we have? We have already crossed 12:30. Of course, I don't have much pending left. I can quickly run through another 5-10 minutes. Is that okay? 10 minutes is okay?
Yes, sir. Fine, sir.
Okay.
We can extend to like 20 minutes more also.
Okay.
That's not
Okay. I think by that time I will be able to complete.
Sir, because our session started at 11. So
Yeah.
that is fine, sir.
Okay. So security, as we discussed. The next reporting requirement in connection with again borrowing is whether the company has utilized the funds for the specific purpose for which it was borrowing. I don't see any major challenge here. I mean, already bankers were asking for end-use certificates in this case, and we as an auditor were issuing a lot of certificates for client where we were giving end use. So similar analogy or same structure one will have to follow to report under this clause, and the processes which we were following to give those certifications have to be followed here. But for all practical purpose, I mean, the only challenge where it will come is where there is a common pool account. So one has to take a balanced view while there is a common pool account maintained, wherein your regular funds also are coming and your borrowings also have come and the funds have been utilized. So one has to take a balanced view and accordingly do the reporting here. If there are specific accounts where the money has come and you have spent the money, the client has spent the money, then the problems are less. But the challenges will come in the common pool account. But again, we are not new to this. We had been issuing end-use certificates. The same process has to be followed here. Okay. The next reporting requirement again is in connection with the funds borrowed and advanced on the both sides. And again, the ultimate logic here is utilization of funds. So the reporting for this paragraph is if you have used any intermediary for the ultimate funding. Example, I have lended to entity A with a clear instructions to entity A that these money should ultimately go to either say entity B or for the benefit of entity B or for the purpose of entity B. If those layers are used for borrowing funds and for lending funds, then the reporting has to be done under this paragraph that yes, when I lend it to entity, to a intermediaries for specific purpose, and intermediary has utilized those money for that specific purpose. So those reportings have to be done here. So it would be for borrowings and lending both. It would be also in a scenario where you have given guarantees or securities for or on behalf of the ultimate beneficiaries. वो reporting भी आएगा. और reporting क्या आएगा कि amount or date for those loans borrowed or invested or lended. Further intermediaries को जो दिया है वो guarantees information and a declaration that these transaction is not violating the money laundering act of FEMA. So though you may have a clear structure for these kind of transactions, it would have been an approved structure even by the board that yes, you do it this way. but one has to also give a categoric declaration that by doing this, you are not preventing a money laundering act, or you are not violating the Prevention of Money Laundering Act. So again, this is a factual based information, but as an auditor, you have to be clear that who is the ultimate beneficiary, and all those disclosures related to those dates, amounts, ultimate beneficiaries has to be given. So this was similar to like an end use kind of reporting requirement, that जो money का purpose था वो उसके लिए utilization हुआ है कि नहीं हुआ. So these were again few clauses which was talking of borrowings and lendings and accepting money for this specific purpose. As I said, the whole objective of these kind of reporting is to ensure that money has not been laundered, money laundering has not been happened for those transactions, and the money has been utilized for the purpose which they were borrowed. The next reporting requirement is willful defaulters. So as we all know, the entities are declared as willful defaulters by RBI. Generally, by the bankers. Generally, this information is available on the website of RBI. So one has to make sure that until the date of adoption of financial statements, it is not only up to the date of balance sheet date. If something has happened after the balance sheet date but before the accounts are approved, then also if the entities are declared as willful defaulter, then the reporting has to be done. The reporting then is very simple, that the date of declaration of willful defaulter has to be given, and what is the nature of default which has happened, which includes amounts and nature of default. So these disclosures have to be given if the entity is declared as willful defaulter. CFS, if you are consolidating the entity or associate company which is willful defaulter, and if it is material to the group, then only you give the disclosure. So if an associate company which is not a material to the group entity, and if that entity has been declared as willful defaulter, you may not cover as a part of your CFS disclosure. So declaration of willful, the timing. So again, it could have been declared at any point of time during the financial year. Even as we discussed, after the balance sheet date, you still have to be declared. You still have to give the disclosure. Now, there could be a situation where the company would have been declared as a willful defaulter for part of the year, but at the year end, that declaration was removed. Now, as on the given date, the company is not a willful defaulter. That default has been cured. In such case, my view is you should still report, because even for the partial year, the company was declared as a willful defaulter, and you should give the fact along with the fact that by year end, that default has been cured. Now the company is not a willful defaulter. So when is the willful default? So basically, when you would have defaulted in payments of your loans or other obligations, or you would have diverted the funds, one gets one gets declared as a willful defaulter. Kind of transactions, so banking transactions, as we discussed, and where to obtain this information, as we discussed, that this the information are generally available on the portal of RBI. Next, in case of registration of charges or satisfaction with register of companies. Now, for all practical purpose, as of now, generally bankers were ensuring that all the charges which the lenders were ensuring that whatever charges have been created, they used to ensure the necessary forms are filed or not. Theoretically, those responsibilities of filing the forms for charges and satisfactions lies with the company. Company has to ensure that those forms are filed on the timely manner. So this is again more of a factual information, wherein whether the charges which were supposed to be created are created, and if the satisfactions were to be done, whether they are created or no. So the factual information has to be given in terms of what are the charges or satisfactions, which ROC this belongs to, what is the period, and if there are any delays in filing those forms when it comes to charges or satisfaction, what are the reasons for those delays. So this is an additional requirement for satisfaction or charges in case of entities registration. The next requirement is compliance with number of layers of companies. Now, as far as NBFC Act or law is concerned, one has to follow two layers of registration, two layers of entities. So, for example, entity A is an holdco. There's a subsidiary entity B. There is another sub-subsidiary entity C. So there is when this entity C is there, entity C is sitting on a second layer. So as far as RBI is concerned, NBFC law is concerned, sorry, they can maximum layers be only two layers. So we saw A, B, C, which is the second layer. Assuming for practical scenario, there is an entity D, which is again a subsidiary of entity C. So that layer of, and you are an auditor of entity D, that layer is third layer and not the second layer. So any layer beyond 2 has to be reported that yes, this entity is at this layer, and those relationships with the downstream companies have to be disclosed here. So you have to stop at layer 2. More of a theory requirement. Practically, you would not find these situations much. It will be very, very, very excessive situation. But yes, any layers beyond 2, one has to report as far as new amendment is concerned. I think with this, I have completed balance sheet amendments or disclosures, which is assets and liabilities. Any specific questions so far?
We can continue.
So when it comes to P&L, not much changes. Those are more of a cosmetic changes. We discussed this on the face of P&L. Earlier, it was revenue from operations, other income, and total revenue. Now it is total income, and we discussed that. This total income is now linked to that mandatory rounding off, and this is what you have to refer to. When it comes to revenue from operations, there is an additional line item, grants or donation received. So far we were reporting sales of products, sales of services, other operating revenue and excise. Now there is an additional line of grants or donation received. This is more relevant in case of Section 8 companies, and they have to report under this category. Again, this is more on the face of the company, the face on the P&L. Undisclosed income. So any undisclosed income accounted or committed, or rather I would say not even accounted, any undisclosed income which is committed or surrendered during the year, irrespective of whichever year it belongs to. So for example, there was a search or a survey on the company in AY 1920, and final conclusion happened, say AY 22-23, which is the relevant year for our audit, and company has declared or committed any undisclosed income there. In such case, those reportings have to be done here, irrespective of for whichever year this was disclosed. Since it was committed during the year, these reportings have to be done here. This again more or less will be available from the assessments proceedings data which the company would be mentioning, the returns which company would have filed under section 148. So you have to compile or verify those informations from here, those available information, and accordingly reporting has to be done. Reporting fairly, again simple, assessment year which to which pertains, section, amount, transactions, assessment status, so on and so forth. One word of caution one has to ensure here is, sometimes what happens for a company takes a practical view in terms of additions to books of addition to assessment. So assuming on a random basis, AO would have added 100 rupees in the assessment. Company don't prefer appeal on such case. Now those kind of additions should not tantamount to reporting under this para, because non-going into appeal will have a reasons. Company would not have gone to appeal to buy peace, or for all practical purpose, litigation's cost may not warrant those cost benefit analysis, and hence they would have accepted the assessment order. Now those situations will not be covered under undisclosed income, and those should not be reported here. That is one has to keep in mind. Another important aspect one has to keep in mind while reporting under this paragraph is any demand notices raised would not tantamount to reporting under this paragraph. This will warrant only and only when the company has accepted that yes, they are accounting this, or they are accepting this as an additional or undisclosed income. in their returns or any other communications. So this should not be only one-side communication from the authorities. It should be acceptance of the company. Then only reporting is required under this paragraph. So emphasis is on the word surrender or disclose. We discussed, in case addition is made by income tax authorities and the company has disputed, reporting is not required. Company chooses to not file an appeal, reporting is not required. CFS, while you are reporting, you have to just give the name of entity, that which company this has, under which company this reporting, these additions have been happened. Okay. Simple requirement when it comes to crypto or virtual currency transactions. If the company has entered into these transactions, then the profit and loss involved, amount of currency outstanding as on the reporting date, and if company has given any advances or deposits for these transactions have to be reported under this reporting requirement. CSR activities, we had already been used to. MGT7 already asked all this information. In fact, CSR2, if I'm not wrong, there is a due date that we have to file CSR2 for all the entities. We had to file CSR2 for all the entities who were covered under CSR activities. So the reporting requirement here is additional reporting requirement here comes as shortfall. So if there were any shortfalls, then what are those shortfalls? Whether those shortfalls belongs to previous years, reason for shortfall, and nature of CSR activities taken by the company, undertaken by the company. So these were few additional reporting requirements when it came to P&L. Any specific questions on this overall presentation which we made, or last clauses which we have taken up?
Thank you so much, sir. If any members have any queries, they can unmute themselves, or they can, put the question in the chat box, and sir will be happy to address the questions.
So there are specific requests in the chat box that sharing of presentation. Definitely, yes, I am going to share this presentation with the organizers. Gaurav, please take it forward from there.
Yes, sure, sir, definitely.
One more request was any Excel sheet duly tabulated in or for amendments. Specifically, the answer is, as of now, I have not done that, but yes, I am in the process. Once I do that, I will share with Gaurav. I can assure you that.
Thank you so much, sir. I guess since the queries were resolved at that particular moment only,
so these are my contact details. In case you have any queries anytime, you can drop me an email with the reference of the study circle. I will be happy to answer the questions.
So, sir, thank you on behalf of Andheri Study Circle. I would like to extend my vote of thanks. And thank you for sharing your valuable time, insights, and knowledge on today's topic. Very important topic, amendments in Schedule 3. And so you have, very patiently and in very detailed, you have take each clause and explain each amendments. So thank you so much, sir. We'll be looking forward to hear from you again.
I hope I have been able to do the justice for the benefit of members. That was the whole objective.
Yeah, so it was. Okay.
Right.
Sir, thank you so much. Thank you so much.
You.
Sir.
Can I disconnect now, Gaurav?
Yes, sir. Sure, sir.
Thank you so much.
Thank you.